Hey guys, how are you? Thanks for joining the Home Buying Podcast. This episode is going to be a little bit of a deviation for us from the single family space. We're going to talk about commercial real estate. I frequently get questions and inquiries about commercial real estate, how to invest, what's the best way. I thought that we could speak with a professional about it. We have Ava Bouwkamp here from Agent Optional. She is in Des Moines, Iowa, and she's in the commercial space. I'll let her introduce herself and kind of give us a background about you, how you got into commercial real estate, and what you guys do at Agent Optional. And by the way,
Yeah,
thanks for
well,
joining me.
yes, thank you very much for having me on the podcast. I know, like you mentioned, a little bit of a deviation from the home side of things, but we have a long history on the home side, so I can talk about our transition from the home side to commercial real estate. So, like you mentioned, I'm with Agent Optional, and I'm the investment relations manager for Agent Optional, and we help elite realtors, other people in the real estate space invest passively in commercial real estate. And when I say passive, I mean hands-off real estate investing. So we're not talking about going out and buying a commercial building on your own. But my team, what we do is very simply, we source and review hundreds of commercial deals in a given year. We're always evaluating, underwriting different commercial properties. In the Midwest, we buy mainly industrial real estate. But as our team evaluates different properties, if something looks good, we will put it under contract and we go through that due diligence process. So we're evaluating that building on the physical side, on the legal side, on the financial side. And if those three boxes line up and things look good to go, we will present that opportunity, that building, to our network of private investors. So these are investors that we have a relationship with, we know them, we've talked to them, and they're interested in investing in commercial real estate. And if that building lines up, they like the deal, they have the opportunity to watch a lengthy presentation, get all kinds of information on our business plan for the deal, what kind of financing we're putting in place. And if it lines up, they have the opportunity to invest in that building. They can buy an ownership share with their investment in that deal and then earn passive returns on their investment. So that goes in proration to how much they own of the deal. And then our investors also get passive tax losses. And when we sell the building or refinance, they get a slice of that ownership equity appreciation as well. So a long introduction to what we do, but we came from the single family side, and now we help other realtors and other people in the real estate space invest in commercial real estate.
Awesome. Sounds very interesting and very detailed. I'm sure I have lots of questions. How did you get into, like, you individually? Did you start in the real estate world? Like, tell me a little bit about your journey.
Yeah, great question. So I had very humble beginnings. I'm not a real estate agent myself, and I never have been. But I actually started as a transaction coordinator for my boss. So I was doing everything on the transaction side of things, both traditional home sales on the market, on the MLS, managing all of those. But when I started working for my boss, Neil Timmons, he was still listing homes as a broker, as an agent, but then also doing, hundreds of single family investment transactions, rehabs, wholesales, you name it in the Des Moines area, we've done it. And so I was managing all of those investment transactions as well for him. And over the years, we've scaled up the business, implemented lots of process, procedure, and through kind of a long series of events, we discovered that the single family side was not scalable for where we wanted the business to go. It took a lot of time, energy, and effort for us to get the results that we needed. And we kind of stumbled into the commercial real estate side of things. And once we landed on the commercial side, we knew that's where we really wanted to focus all of our energy. So the past couple of years, we've been divesting single family homes that we own, moved out of the traditional, home sale side of things. And now we are, I'd say probably 80% of what we do is in the commercial side of things. We still do the occasional rehab just because we've got our system down, but now we are predominantly focused on commercial real estate.
Awesome. I think one of the questions that a lot of people will ask, whether they're first-time homebuyers or investors, and this is probably more geared towards investors, is A, how do you source the deal? And B, probably more important than A, what are the matrix that you guys use in order to analyze the deal to say whether it fits into your model or doesn't before you present to an investor group?
Yep, that's a great question. So I'll first touch on where we source deals. On the commercial side of things, we pretty much have two buckets. We have deals that we source through our network of commercial real estate brokers, and then we have deals that we source directly from sellers. So we've built up a network of brokers in the markets that we operate in the Midwest. That means going out, driving out, flying out to see them, spend time with them. And we're just in constant communication with them. Hey, have you seen anything? This is our buy box. Let us know when you have a deal that fits our buy box. And really staying top of mind with those brokers is super important for what we do. So we try to touch those brokers at least once a month, even if we don't, necessarily have an update for them. We're always trying to stay top of mind for them because we don't want them to forget about us. Because for those off-market deals, it's really critical. Brokers in the commercial real estate space control the deals that you get to see. If you're not on that, first handful of phone calls that they make, some of those really good deals you never even get to see them. So the brokers is our one bucket, and the other bucket where we source deals is directly with sellers. So that can mean sending out mailers, sending out email. Those would probably be the main two. Sending out active marketing campaigns to find sellers. And to give you an example, we sent out a campaign to do sale leasebacks. And a sale leaseback is where you have an owner who owns that building. Oftentimes, not always, oftentimes it's someone who operates a business out of, say, a warehouse. So maybe you have a roofing company. You have a gentleman who's owned that roofing business for 20 years. He also owns the real estate, and he's looking to scale his business. And so he's going to sell the real estate and lease it back from the new owner and continue to operate his business out that way. So we set out a whole marketing campaign around that, put together like a 5 or 6 page PDF document to teach these potential sellers about what a sale leaseback is, what it does for their business, and how we might be able to help them. And so that's a way that we can create leads, or at least pique interest in what we do. So 2 buckets, brokers, and then direct to seller for finding deals.
Awesome. It's so funny how that's it's a parallel to what we do on the residential space. Me as a lender, I spend most of my day staying top of mind on the brokers, real estate brokers, who are essentially controlling buyers and sellers. And that's my one bucket. And then the second bucket, much like you, is direct to consumer, which is, potential buyers or sellers if they're.
Yeah. And that's something that we were able to easily translate from being on the single family side. We already knew we had those systems in place. And so it took, we're always looking to improve and get better at it. But coming and having that history in the single family side, single family and commercial are very different, but there's a lot of just skills that you learn on the single family side that can be easily translated to the commercial side. And one of those things is marketing, generating leads. That's important for any business.
Yeah, for sure. Okay, so now to the fun stuff. How do you guys underwrite, so to speak, the deal? What do you look for? What are the criterias? And, as an investor, for me, I invest in single family rentals. I don't do commercial or haven't done any, but always interested, especially in the situation where, I'm not the one that's managing the property, because that is, like you mentioned, a daunting task. So how do you guys underwrite the deal and, make us all warm and fuzzy, so to speak? You guys know what you're doing.
Yes. Yes, that's a great question. So I think I mentioned this earlier. We are mainly in the industrial real estate space. And I'll start with where we look for deals. We are looking for deals in the Midwest. That's like you said, we're in Des Moines, Iowa. So we're looking in Iowa, Kansas, South Dakota, and a couple of other, Minnesota, a couple of other states across the Midwest. And that's our first bucket, because that's where we have the most connections. And then we're looking for cities that have at least a population in the near vicinity of about 100,000 people. That's just kind of a benchmark where we like to peg a good enough, stable enough population base with a wide variety of employers. We don't want to have most of the population employed in just a handful of areas or businesses. So going to that $100,000 or 100,000 people mark kind of helps give us a little bit of diversity there. And then we're looking for small to mid-balance industrial. So what that actually means is we're looking for anywhere from 10,000 to about 80,000 square feet of industrial space. And we're looking for buildings that are 1970 to 2020. On the newer end, you're going to get a lot more expensive. So that's why we give ourselves a little wiggle room. I'll say 1970 to 2010 is more in the range where we're looking at. And then if it's a value add deal in industrial, we're looking for equity that we can realize within 5 years. So maybe that means filling in new tenants, putting new tenants in, putting the existing tenants on better lease terms, adding additional income streams, maybe through outdoor storage, or simply, reducing expenses, that kind of thing. So, kind of a 5-year timeline on the value add side of things. If it's a cash flowing deal, we're just looking for, 150 basis points over, current loan terms for spread so that we have enough cash flow. And then there's a lot of tenant underwriting beyond that. But that's a really quick snapshot for us to know, is there enough cash flow in the current underwriting or the current loan market for us to be able to have enough spread? And then from there, there's a lot of details we have to go into in terms of, is this a good tenant? What are the lease terms? How long are they going to be there? What do we think the building will appreciate at over our hold period? But those are a quick snapshot for us on the value add side and the cash flow side. We're really looking for those smaller, I call them smaller industrial buildings, because that places us under the radar of institutional buyers. We're not looking for really huge 100,000 square foot buildings, just those smaller, warehouse where you're going to have a local business or maybe a national business that has franchise locations that we can kind of fly under the radar of those institutional buyers.
Got it. That makes sense. And, for define industrial for us, right? Because some people may not know what that really means, and some people do, but they may need a refresher.
What is industrial real estate?
Yeah.
Great question. They're the buildings that you don't really notice when you're driving around town. They're the big, large metal boxes. Often they will have big roll-up doors, tall doors, drive-in bays for semis. Basically, they're very flexible. The same tenant can look at a wide range of industrial buildings, and that's one of the things that we really love about industrial real estate. One building can appeal to someone who has a window company, maybe someone who has a car parts company, maybe someone who they do batting practice. You can just have a huge range of tenants fit in industrial buildings. Sometimes they'll have a little bit of office space for, front end personnel, but then the back, basically you're looking at big open space.
Awesome. Makes sense. And, I know you mentioned 150 basis points over the loan terms. So just, can you give me like a brief example, in dollars, what does that look like? Like, let's say if it's what's your typical purchase size? 2 million, 3 million?
Yeah. In the $2 million to $10 million range.
Yep. So let's just use, I don't know, $5 million is the purchase price. I'm assuming it's a 25% down payment, right? So we've put in $2.5 million. No, sorry, we put in $1.5 million. The loan is $3.5 million. And so 150 basis points over the payment. Is that like what you meant?
Yeah. Yep. I think we're on the same page there. Yeah. I should add one comment on the down payment side. Commercial loans can have a wide range. You're looking at anywhere from a 20 to 50% down payment. Just depends on the asset type, depends on the quality of the building, the quality of the tenant. Especially on industrial, banks are going to pay close attention to what is that tenant's ability to pay. And so that's where we spend a lot of time focusing, especially if it's going to be a triple net, double, triple, absolute net lease. We're going to spend a lot of time evaluating that particular tenant to make sure we can form a strong thesis that they will have a strong ability to pay.
Got it. Okay, makes sense. But let's say if the payment is $10,000 a month, if the mortgage payment is $10,000 a month, are you looking at something that is 11.5? Is that what you meant by 150 basis points?
Yeah, at least. That's just a bare that's a very quick snapshot judgment. It's not going to be, there's a lot of other factors that will go into it, but that's a quick. Yep.
Okay, makes sense. And then I'm assuming from then on, like me as an investor, or like if I'm a potential investor, whatever the down payment is gets split among the number of investors that are going to come in. And that is how the prorated share of the profit is distributed. Am I assuming that correctly? Okay.
Yep,
And then
correct.
you guys, as the manager and the aggregator of the property, are you also investing dollars? Is there skin in the game, or is there not
Absolutely.
skin in the game? Okay. How does that
Absolutely. We'll put anywhere from 10 to 50% of the equity that's required to purchase that deal, often guarantees that go along with the lending as well. So we like to make sure as much as possible that we can align our incentives with our investors' incentives. And if something would go south, we're going to be the ones who, in most cases, hurt more than anyone else. So we didn't start taking investors into any of our deals actually until very recently, up until about probably 70 to 80,000 square feet of property. We hadn't brought anyone else in to buy all of those buildings. We had bought all of those deals with our own money without taking any outside investors in. And that for us was really, really important because we didn't want to go out and take investors in if we hadn't, done the hard work, done the dirty work to make sure that we had the right team in place, the right systems in place to go out and make these deals work without taking investors in. Now that we've scaled, we've got connections, we've got a good team in place, we feel comfortable bringing investors in. But it was absolutely critical to us that we had the experience and the track record with our own dime, with our own money before we brought any investors in to participate.
Yeah, awesome. That makes sense. So, example of returns. I know, they can range, but let's say $500,000 looking to invest with you guys. I'm comfortable with the industrial space and the geographical location. What am I seeing typically percentage wise year over year?
Cash on cash, anywhere from 8 to 13, 14%, just depends on if it's a, stable cash flowing deal or if it's a value add deal. I know that's a kind of a squishy answer, not super hard and fast, but those time frames, if it's a value add, we're looking at anywhere from a 3 to 5 year time frame, shooting for close to a 2x, double your money with that value add project. And if it's a cash flowing deal, lower risk, lower reward, a little bit more stable, and you're just looking at, usually quarterly distributions there. But real estate is, I'm going to give my little disclaimer here. I'm not a CPA, I'm not a financial advisor, I'm not an attorney. And every deal has risk. I think you'll hear a lot of people on social media, on different platforms, always giving you all of the positives and all of the upsides. But real estate can go south, deals can go wrong. And so you should never invest in something where you're not comfortable with the risks that you're assuming. And you should always keep in mind that real estate is an illiquid investment. This isn't like a stocks or bonds where you can buy and move funds in and out very easily. If you're invested in a deal, you need to be comfortable being with it, for the long term. That can mean anywhere from 3 to 10 plus years.
No, sure. Totally. I get it. And, and my experience over the years has also been, if you can hold the property through the tough times, eventually there will be better times. Fortunately or unfortunately, I was around in 2008 and, and in some cases I was able to hold on to some of the things that I had. In some cases I wasn't. And, obviously hindsight's 2020, but if you look at those assets, and they were in the individual single family space or condos, if you look at those assets today, they've quadrupled. So
yeah, we wouldn't be having this podcast if we had all, been able to scoop up a bunch of assets in 2008. It's interesting you bring up that point because there's a lot of distress right now in the commercial real estate market, in the commercial loan market. And you see, like, I'm blanking on the number off the top of my head, but trillions of dollars of commercial debt coming due between now and 2027. Yeah. So there's a lot of churning in the commercial real estate market right now. But I think a difference that you see between the 08s and where we're at now is lenders realized if you're able to get your borrower and those assets through these couple of tough years and hold on, to get through it, things will most likely turn out okay. But that's one of the big differences between the single family space and the commercial space is those loans on the commercial side, they're 100% due and payable after, 5 years, 7 years. And so you might have it amortized over 25, 30 years to make those payments more manageable, but you have a giant lump sum payment at the end. And that's where you're seeing, if you've seen a lot of scary headlines about the commercial real estate space, that's where it's coming in is you have people who bought properties when debt was at, 3%, 4%, and now they're having to reprice or they have floating rate at, 7, 8%. And to make up that difference, it can be impossible, even if operationally everything at the property is actually doing really well. It's just a factor of that debt.
Yeah, no, for sure. But I think that, one factor is you being in the industrial space, you're a little better, I guess, situated than someone who was investing maybe in office space pre-COVID. And, now we're all working from home, or most of us, and not all of us are going back. So I think, it's really hard for a window manufacturer to work from home, or an HVAC company, or a roofing company, or an electrical distributor, or whatever the case is. So there is some safe haven in the industrial space, and then also I think that unlike on the residential space, I'm assuming most of the loans that are written in your space are, local banks or maybe regional banks at most. And so it's not in the box or out of the box. It's more like common sense, like, hey, do we want to take a default on this property and try to sell it? Or do we want to restructure the loan and maybe, take some of the interest and balloon it out when times do get a little better, when rates get a little better, and we have a borrower that's paying in a timely manner. Is that kind of what you're seeing?
Yeah, definitely. And one thing that we also really like about industrial is by and large you have tenants that are on longer term leases.
Yeah.
So you're looking at a tenant that's in a lease for 5 years, 10 years, up to 20 years with regularly scheduled increases in their lease every year, anywhere from 1.5% to 3%. And so you have a much better ability to predict cash flows out, and that helps with your relationship with the lender. And you can miss out on some of that upside if lease rates really bump up and you've got a tenant that's in a long-term lease where you're not able to capture some of that really quick appreciation, but it does give you quite a bit of buffer against some of the churning that you see even in like an apartment building where you have tenants turning over every year, every 2 years. Industrial, you've got tenants in for 5, 10 plus years, and that's something that we like, that downside protection.
Awesome. So kind of, I guess in summary, how do we get a hold of you if I'm an investor or I'm an agent that's maybe helping or working with a group of investors? I know I'm more in the Northeast sector, but I think that a lot of people that I talk to that are in investors in real estate and commercial real estate find that there is a lot of value in the Midwest because the price points are much different than New York, Pennsylvania, New Jersey. And so your dollar may be buying you a lot more in Midwest, and therefore your return is going to be a little better. And then you mentioned 2x on the value add, which is very hard to see here in the Northeast. So share contact info. How do we get a hold of you? What's the best way to reach out?
Yeah, best place to find me is just our website, agentoptional.com. That's just agentoptional.com. If you're a social media person, I post on LinkedIn almost every day during the week. So I try to post a lot of valuable educational content. So even if you're not someone who's, interested in investing, but you just kind of want to track along, learn and kind of watch from the sidelines, I'm very active on LinkedIn. So it's just my first name, Ava Bouwkamp. And then our website is agentoptional.com.
Awesome. And, I always ask this, and I forgot, I probably should have asked this before the contact info. Give me one nugget or two nuggets. I'm a commercial investor. What's like the one thing I should look for, whether it's to select the right partner when it's a pass-through investment, or, if I'm actually going to get my hands dirty and find the property, give us like one or two suggestions.
Yep. So I'll give one for each.
Yeah.
If you are a passive investor, you hit the nail on the head. Your first and one of your most critical moves is finding an operator, a general partner that you can trust, someone who has a long track record, a track record of success, of doing deals on their own, of figuring things out, and they should be willing to hop on a call with you and answer your questions. They should be willing to sit down and talk with you for 30, 40 minutes for at least, that initial conversation to get to learn more about you, your background, to see if real estate it has to be a two-way street. And so from a passive investor, you're really looking for an operator that has a long track record of success and someone that's going to take an interest in learning more about you to see and evaluate, like, is this even something that is a good fit? And then from an active perspective, start small. If you're coming from the single family side, I want to encourage you that there are a lot of things that you've probably learned and picked up on the single family side that will translate to success on the commercial real estate side. I can't promise that you're going to hit it out of the park at first, but maybe if you're coming from the single family side, a great way to get your toe on the commercial real estate side is a small apartment. Maybe it's a 6-unit, 8-unit. You've already got experience on managing tenants, on managing maybe updates and rehabs. And so find that natural next step from a property perspective. And then also look around you. Maybe that's on the internet, maybe that's in your local area, and find someone who's 3-4 steps ahead of where you are from an ownership perspective, and reach out to them and ask them for a little bit of guidance, a little bit of help. And I'm sure that they will be happy to extend a hand back to you and say, here are some of the things that I learned when I was going through the same thing that you were. Here are some things that I learned when I scaled. So look for someone who can give you a little advice. They're not way far ahead of you. Like a Grant Cardone is not going to be necessarily a helpful person for you, but someone who's a couple steps ahead of you. And then find a natural bridge from what you're already doing, maybe on the single family side, to an apartment building that's 6 to 8 units and a little bit easier for you to sink your teeth into.
Awesome. Awesome, Ava. Well, listen, I really appreciate your time. Lots of knowledge. Guys, hopefully you take that into consideration, especially the investors that are here and join us. I think industrial real estate is a great space. So please reach out to Ava and she may be able to help you. Thanks a lot. And thanks for joining.
Thanks for having me.
Yeah, absolutely.